Hello, everybody, and thank you so much for sticking around. It's raining outside, so stay inside where it's warm and dry and enjoy a really amazing conversation with my incredible panelists. I'm honored and privileged to be here with you all today. These folks you see on the stage are leaders in the area of private foundations, not only in terms of allocating capital in their grant-making pools towards generating positive impact in the world, but more importantly and relevant to this conversation, using all of their resources, right? Also the financial capital, the invested capital, to align towards the mission of the institution and generate the greatest possible impact in the world. And as everybody in this room knows, each foundation or individual or institution's journey on this path to align capital with creating positive impact in the world is unique and differentiated, and that's just what you'll hear today, that everybody has a different approach, different path along this journey of aligning their foundations with generating positive impact. And so we really hope to take you on kind of the practitioners behind the scenes of what that looks like, from soup to nuts, defining the space, getting key stakeholders on board, and then of course implementing implementing over time and iterating as you seek to further refine the positive impact that you're making. So we're going to start out, first of all, with some brief introductions, just to really bring alive who's on the stage today, and then we'll dive right into the content. And I mostly look forward to your questions at the end, because I know that's really where our conversation will come alive. So just very quickly, my name is Lily Trager. I have the privilege of leading Morgan Stanley Wealth Management's Investing with Impact platform, working in collaboration with the firm's broader sustainability efforts, led by our Chief Sustainability Officer, Audrey Choi, and the Global Sustainable Finance team. You heard Anna mention the Institute for Sustainable Investing before, and our job is to really invest in the best and brightest ideas for individuals and institutions that are aligned with their values and impact objectives in the world. So I'll pass it over to my panelist, Bob Bancroft, to just talk to us about kind of your role and how you got into the space.
Sure. So my name's Bob Bancroft. I'm with the Nathan Cummings Foundation, and I'm the Vice President of Finance for the organization. I'm new to the team, so I just joined earlier this year, but I've been in the private foundation space for about 11 years now. And prior to that, I had a kind of eclectic path working through some entrepreneurial pursuits of my own. But I think what really stuck with me about being in the nonprofit sector and with private foundations is to experience social justice as a way of empowering individuals and recognizing the potential that exists in each of us. And I think once you acknowledge that, you can't help but feel compelled to do something about it. So as someone who spent a lot of time in the finance and accounting side, for me, the opportunity to sort of work at the intersection between that financial skill set and social good is really awesome. So I'm delighted to be here and delighted to share a stage with these esteemed colleagues of mine.
Yes, my friend Preeti Bhattacharji, would you mind going next?
Sure. I'm going to steal eclectic path because I also have an eclectic path.
Which began at Columbia.
Which began double Columbia alum, undergrad and B
yes.
school. So very excited to be here. Going to be very candid because you are my people. So I am the VP of Integrated Capital at the Heron Foundation. So we co-lead all capital deployment and management, roughly 300 million, public, private, debt, equity, and grant making, direct and indirect. We can talk about any of those. And what brought me to the path to this place, very candidly, was a sense of the culture and the people. I found myself on the nonprofit side, really appreciating the fire in people's belly, but sometimes getting a little bit frustrated with what I felt was a lack of quantitative analysis. And I found myself on the capital market side, really loving the quantitative rigor and feeling like my soul was burning. And so this space to me was really an interesting intersection where I could bring that rigor and that quantitative nature to the things that I felt most passionately about. And it's played out that way. That's really, the space is full of people like that, and I love it.
Amazing. Shuaib?
Great. I'm the director of impact investing at the Surdna Foundation. We're a $1 billion foundation, very similar to Nathan Cummings, focused on a on social justice. My path was very similar to Preeti's. Again, I would refer, a reformed Wall Street person. But ultimately, for me, what's exciting about the nexus of using sort of the investing skills, but also solving major intractable problems, it's just really exciting that you get to dig in and say, okay, how do we use capital to solve problems? We can't solve all of them, but which are the ones, and how do we determine which is the highest and best use of that capital? To me is an exciting challenge, and it is the people. Really working with amazing colleagues that ask each other the difficult questions. And I think that's what's really exciting for me.
Great. Can we just start maybe in as few sentences as possible defining the mission, either reciting the mission statement or just giving us a one-liner on the mission of your private foundations? Bob?
Sure. So we seek to promote a more just and vibrant democratic society, and we primarily focus on what we see are the two major challenges of our day to getting there, which is climate change and economic inequality.
Thank you.
So our mission is to help people and communities help themselves out of poverty, and we have a U.S. focus.
Great.
We have a U.S. focus as well, and our focus is to help build healthy and thriving communities in the United States.
Great, perfect. So I think that gives everybody in the room kind of a sense of what each of these foundations are seeking to align their capital towards, whether it's on the human capital, the philanthropic capital, or the financial capital side of the equation. Today, obviously, we're going to be focused largely on investing and how to take that financial pool of capital and align it with the mission statement. But before we jump into the individual journeys, we just want to level set on some of the terminology and ideas that are pervasive in this space. You've heard a lot of terms thrown out today, or you've been privy to many terms throughout your studying of this industry. And so we want to really bring it into the context of institutional investing. What are the different approaches and areas that we are pursuing from the perspective of mission-aligned investing in the context of a foundation? And even before we go there, right, just defining generally what a private foundation is. In our kind of latest report called Mission Aligned 360 at Morgan Stanley, our research showed that there's over 100,000 private foundations here in the US. And these private foundations are required to distribute at least 5% of the investable assets, right, through typically grant-making, program-related investments, and sort of concessionary style investments. And that 5% amounts to $60 billion annually, right? So you think about the 95% of capital that's sitting in the bank that could make such a great positive impact if it were combined with that required annual distribution. That's what we're talking about today, is that 95%. So anything else definitionally around foundations? You think that covers it? Okay, great. Then I'm going to turn it over to Preeti to just really walk through the spectrum of approaches that you use at Heron, but broadly in the space, from kind of that negative screening orientation to impact investing and how those all fit together.
Sure. So I guess the quick version of this would be to just give you a quick narrative of how we got where we are. So we're a private foundation founded in 1992, and for about 10 years, we were a pretty traditional foundation. We invested our endowment for maximum financial returns. Every year, we'd scrape off 5% and use that for charitable distributions, which basically means grants and some of your expenses. And that's what we did. That's what a lot of foundations in this room probably do. And about 10 years in, we were in an investment committee meeting, and one of our trustees asked this question that completely put us on a different trajectory. They asked, what if our investments are actually feeding the very problems our grants are trying to solve? Which was a terrifying moment and led to a total identity crisis for the institution. And the truth is, we didn't know the answer. We didn't know whether or not our investments were feeding the problems our grants were trying to solve. And so that in and of itself led to a massive exploration around what on earth do we own and what are the effects of those investments on the people we care about. And so fast forward, the tools we have since deployed, we started just by asking the question and doing that inquiry around what is it we own. And then from there, we went very incrementally and continue to work incrementally. We started with fixed income and said, fixed income is a fairly straightforward asset class in that you can geocode those securities. Where are those investments? What are the uses of proceeds? How do we think about whether those are the right mortgages or the right types of investments we want to be making? From fixed income, we went to public equities. From public equities, we went to private equity. We just went through the asset classes. And asset class by asset class, we started rotating. So it wasn't a wild, complete rework of the portfolio, but within each asset class, our goal was to say, what can we do that's better? What can we do that's better than what we currently have? That's the quick version.
That's perfect. And maybe just continuing on that train of thought for a second, maybe speak to kind of what's inside the portfolio today and how it maybe represents those different tools or approaches in the industry.
So the portfolio today, in some ways, if you look at our RIA is Cambridge, if you look at one of our Cambridge reports, it actually looks very similar to the way it looked when we had that identity crisis. It's 70-30 equity debt. You've got a mix of public and private. We have grant making as well, which feeds into some of the other work. But from an asset class allocation perspective, it looks very similar. What's different is once you dig into those asset classes, you get a different sense of the enterprises and securities within them. So for example, we used to own mortgage pools, like everybody in this room probably owns mortgage pools at the very least in your retirement account. Now every single mortgage we own is indexed as affordable to the buyer on a 30-year basis. So specifically, we look for and identify mortgage pools that are in low-income census-tract communities. When it comes to the public equities, we dive painfully deeply. It's actually really exciting for us, but for other people it's painful. Really deep into what are the effects of these companies, their core operations, their supply chains, and their products and services on the very people that we care most about. So the names and the weights have changed, but from a portfolio construction standpoint, it actually looks very much like it used to look.
And are you employing tools of any overlay restriction screens or employing ESG integrated managers or thematic managers?
So we tend to be anti-screening. And the reason we tend to be anti-screening, we actually originally thought screening was going to be a great tool. Once we had our identity crisis, we said, okay, let's screen out all the bad stuff. We were just chatting about this. Let's get rid of the bad stuff, and then it'll be okay. And we started to screen out the bad stuff. And first of all, it led to the debate many of us, I'm sure, have had around what counts as the bad stuff. And I think in a more nuanced way, we realized screening out for us was too blunt of a tool. Because by screening something out, by saying all of tobacco is bad, all of gambling is bad, all of whatever it is bad, first of all, we were making a values-based judgment, not a data-based judgment, and we weren't appreciating that, well, tobacco companies produce tobacco, they also employ people, they also have supply chains. Maybe that means you end up continuing to screen them out of the portfolio, but we lose that nuance. And we lose the nuance of who's best in class. So relative to peers, who's operating well, who's operating poorly. And so instead of creating negative screens, all of our screens are zero-based screening. So we start from the bottom and you basically have additive points. And then you see where things level out. And if weird things add up in the portfolio, the trick we try to do is we try to build a better mousetrap then. So instead of just bluntly screening things out, we're constantly trying to build better positive screens.
That's great, very helpful. Bob, Nathan Cummings Foundation made an announcement, I think in March of this year, that you were going all in for impact. How have you sort of defined as an institution this idea of mission-aligned investing, and what tools and approaches are you guys accessing?
Yeah, so I mean, a lot of what Preeti was sharing really resonated with our experience as well. We were just talking earlier, once you embark on this path, be prepared for a lot of unexpected but super interesting questions. And those questions don't stop. So we're seeing an incredible amount of engagement with our board and throughout our whole staff. So the most basic question, once you make a commitment to 100% mission-aligned investing, is what is mission-aligned investing? How do you decide, and to be less cheeky about it, how do you determine criteria by which you can decide that any given investment is aligned or not? So our first cut at it was to look at a whole bunch of ESG related data, looking at the ESG exposures, and we think that data is super important, by the way. And it should be important to any investor, regardless of whether you are an impact investor or not. But that didn't allow us to determine whether an investment was aligned. And so then we started looking at impact metrics, and those are really important too. Important for the integrity of the program and important to determine whether you're having success or not. So we think those are important, but that ultimately wasn't working for us either. And so we've started to develop a toolkit of qualitative criteria. And just to give one quick example, so we think about the intentionality of the manager. In addition to the manager's investment thesis, do they have an impact thesis? And once we can identify that, we can ask ourselves, well, how does that impact thesis align with and support the mission and goals of the foundation? Because as a long-term investor, foundations, we measure our time horizon in decades or centuries. It's not only about what's in the portfolio right now, although that's very important too, but it's about, is this investment manager going to be making decisions in the future that support our objectives? And so concepts like this intentionality have been very useful to us.
Such a great point, Bob. I work with a number of clients who find an asset manager that they fall in love with. They really like their performance and track record. They look at their overall holdings and they say, well, they don't have any exposure to whatever the issue is that you're trying to avoid. But as part of the prospective language or the guidelines of the investment strategy, they haven't committed to not owning that in the future, right? So you could have to rotate out in the future. So this intentionality piece plays such an important role in the upfront work of understanding an investment opportunity. Shuaib, take us through your journey. It's slightly different. I think Surdna looks at this more as an experiment and a carve-out than sort of an integrated or holistic approach to total portfolio management.
So what we did, and our board went through this process at about 2015, so it took them about 2 years to really understand what is impact investing. And again, it's one of these things where everyone walked out confused, a lot of terms, a lot of language, and a lot of the board members aren't finance people either, so you have that entire mix. But I think ultimately the board said, you know, this is something we need to do, right? And this is something we need to explore. And so after that 2-year learning journey, the board really said, okay, we're gonna allocate $100 million or 10% of our endowment to focus on impact investing. And part of that commitment, we need to create my role. And bring someone in that has the expertise to help us actually figure out what does implementation look like. And we had a bunch of consultants that came in and helped us figure it out. And like any good hire, I came in and said, everything they said is wrong, this is what we're doing. And so the way that we think about our $100 million, I break it into 2 categories. $82 million is what I call mission-related or mission-aligned investing. And that is where we invest in a mission and values-aligned way in fund managers. And what we're trying to prove here, can we generate risk-adjusted returns relative to our traditional endowment? So we have $900 million sitting on the sidelines. My goal is if I can find managers that are impactful, that are values-aligned, and are able to generate benchmark competitive returns, I can go back to our investment committee and board and our investment advisor and be like, I don't understand why we're not investing in these guys because they've been proven extremely competitive in the returns that they're generating. But we have to start somewhere. And so we're starting with that $82 million. And so I say we're seeking risk-adjusted returns there. And then of that $100 million, $18 million is what we call program-related investing. It's a very sort of foundation term. But the way that I describe it, it's concessionary in that we take uncompensated risk. We're not in there saying, hey, it has to be low return. Our view is that we want to take uncompensated risk. We're trying to help prove a market, prove a business idea. Because our goal is philanthropy has something like about $800 million or $800 billion in investment capital. We're tiny. And if we need to be willing to take risks to help prove where new models work and don't work so that traditional capital can flow in and actually enable them to scale. So that's why we take that risk. And that's sort of where we are and where we landed. We also had the divestment conversation or screen conversation at our board, and it was one of the most difficult conversations I had to lead. I wrote a 13-page memo, and also going back to basic principles that sometimes when you work in finance, you take completely for granted. And you're talking about how stocks move and what is the implications. But one of the interesting conversations, and very similar, that we had was, okay, we want to divest from fossil fuels. Should we actually divest from the extractors of fossil fuels, or should we divest from the consumers of fossil fuels? So do we divest from the airline companies, the logistics companies, because it's actually the consumers of? And the way we ultimately answered the question for ourselves was, actually, if you look at our venture capital portfolio, we're investing in a lot of companies that are developing new technologies that are going to ultimately replace incumbents. I told our board, I was like, no company's going to wake up one day and say, hey, this is bad, and we're going to stop doing it. And the best use of our capital is to support those new technologies. And what the end conclusion around screens was, screens are a tool. It's a blunt instrument, but it's a tool. We have to ask ourselves, what is the change that we're looking to create? And is divestment the best tool in that moment? And for example, with fossil fuels, we're like, we actually don't think it is, because we need to change fossil fuel consumption to actually change fossil fuel, the industry, and our reliance on it. And so that's how we went about really trying to understand, and that's how we use that $82 million as well.
I want to come back to this idea of uncompensated risk because I think it's so important, being foundations on the stage today. But I saw a lot of head nodding around fossil fuels, and I assume that was a conversation around your board tables as well. And where did you guys end up at Heron and Nathan Cummings?
So yes, it was it is a conversation. I would say it's a live conversation right now. Because of our focus on transitioning to an inclusive, clean economy, we do ask ourselves whether fossil fuels are antithetical to that goal. when we looked at the portfolio, we found that we had a very small amount of exposure. So we were starting from a place where this was
Like 2 to 3%?
exactly,
Or, okay, yeah.
and yet it was taking up, many pages of memos and lots of hours of conversation.
Yeah.
So what we did in our case, and it was prompted by a particular fixed income product that we were looking at that had it would have been 20 basis points of exposure for us. It was very, very small, but it was enough to start the conversation. In our case, what we decided to do was to create more space for that conversation and create a mechanism for us to move forward without getting hung up on it. So we looked at the exposure we had, we've set a cap on it, we've established a desire to reduce that cap over time. But in addition, like before I was talking about intentionality, another concept that we use in our conversations is directionality. So if an investment is going to move us toward greater alignment, and part of that manager's strategy is to reward good behavior in the fossil fuel sector, maybe that's okay.
Yeah.
And so that's sort of where we're at on that.
And Preeti, you guys talk about net beneficial to society, which is obviously embedded in this as well.
Yeah, so this is going to be a hard answer. So brace for disappointment. This is a constant debate we have, in part because so many of our peers and colleagues who we deeply respect are leading the movement to divest from fossil fuels. And we're constantly getting appropriately pinged for not divesting. We have not divested from fossil fuels. And specifically the context in which we had that debate and continue to have the debate is really informed by some of the deep community relationships we have throughout some of the poorest communities in this country, many of whom are in Appalachia, many of whom have depended on coal for generations. And so the hard conversations we have been having and continue to have are often with community leaders in these communities that are dependent on traditional sources of energy, who say, we get it. We all see the way the puck is skating. We all see that these are industries that are winding down. But if everybody divests, then tomorrow we can't open the schools because this is the only source of revenue in town. And these are the hard choices you make in the space. Just in case you think the space is all kittens and rainbows, like these are the conversations. It's really not. You have hard conversations and make real trade-off decisions between things that you value. We absolutely value a clean future. We absolutely value clean energy. We absolutely invest in clean energy VC. And we recognize that the fates and livelihoods of so many of the people that we are chartered to serve depend on this economy that has not yet transitioned. And that's a hard balance, and we're constantly living in that tension, but we live in that tension.
And I just want to remind, it's not a binary, because I think that, and that's where I think my greatest frustration sometimes is when I'm talking to peers, board members, or our grant-making staff. And I think that the realization is that when you're in the investing, you want to go to the future, but you also are in the existing. And you have to manage both of those. And for example, our grant teams are always living in the future, and they're trying to push everything in one direction. And my response to them is, we on the investing side don't have that luxury. We have both feet on both sides, number one. Two, we're operating within a capitalistic framework, so we have to remember that as well. This is investment, and it's an investment tool. And not to forget that that's one of the frameworks that we're operating under. And I think that that's one of the things that I always remind everybody.
Such a great point. One of the ways we've tried to sort of counsel other foundations along this journey is thinking about a spectrum of approaches. So even in the areas such as fossil fuels, right, or climate change or climate solutions writ large, right, there's a spectrum of approaches to transitioning towards that lower carbon economy, but also solving some of the community issues that are so real and important today. And so thinking about the time horizon, thinking about deleveraging risk to carbon over time in the context of stranded asset theory and some of the other things that were spoken about in the panel earlier, but doing what's best for the current portfolio given the risk and return dynamics. So thinking about the spectrum of approaches from divesting to proactively investing in climate solutions, new energy efficiency technology, and the like. And that can be the non-binary, as you say, which is so important. So let's talk a little bit more about risk and return. Obviously, well, I would imagine that many of you faced a bit of resistance as you were seeking to orient your portfolios more towards sustainable or impact or mission-aligned strategies, given some historical misperceptions around the performance and the risk embedded in the kind of traditional strategies. But then there's this other pool of investment opportunities. You categorize them as program-related investments, which do, really require you to go in, to deals that have quite a bit of hair on them, as Preeti and I have discussed in the past. So maybe talking about kind of the performance and risk dynamics that you all have faced, whoever wants to kick off.
So I think
Great.
that on the traditional side, where we want risk-adjusted returns, a lot of it is perception, especially around climate solutions. Like, one of the things that I like to sit in our investment committee conversation and remind everybody that you do realize the global conversation around energy consumption has moved from peak supply to peak demand because there's more competition. While solar contributes to about a little over 1% of the total energy, of all the new energy supply that's coming on in this country, 50% of it is from renewable sources. So we are actually missing out on an opportunity. This isn't sort of like we can sit back and wait. If we are about maximizing returns, we actually need to show up in this discussion. And we're actually missing out, and we are actually being derelict in our fiduciary duty by not paying attention to this opportunity. And climate change, in my view, has been politicized, because if you actually look at it from an economic perspective, it makes a lot of sense from jobs. It makes a lot of sense of decentralizing. Like your state, like Iowa, that has no natural resources, guess what? Now you do, because you can use solar and wind. You've just created jobs in your state, and they're not sitting all in Louisiana and Texas. Right? This is the big shift that we talk about. So that's where a lot of that work has been. And again, everyone's like, oh my God, the solar industry went through its collapse that it did go through. I go, what industry that's new and innovative hasn't gone through that? That happened to the internet, right? And what we know today and what happened in the 90s. So this is part and parcel of this, and are we forgetting that this is what it means to build an industry and build a business? We've seen that happen. On the program-related investing side, or the higher risk side, one of the things that we had to ask ourselves was, there's a lot of different ways, again, spectrum of capital on these really risky deals. Sometimes foundations will, and I think it's great work that they do, but they give low return investment to create that are high impact. And I think those are really important part of the capital spectrum.
Like notes or
CDs. Like, 1% loan over 10 years to a community development finance organization that's lending to small businesses. Really important and impactful work. But the reality is, foundations are the only ones that are going to make those transactions. So there's a size limit. There's a rate limit to the amount of capital that'll flow in. And so we think that there's plenty of foundations that are out there doing that work. What we decided to do is said, well, we're going to take a little bit different. We're going to take impact risk. We're going to take financial risk, because we want to try to invest in the new. We think that, if someone came and said, hey, we're developing a new platform to lend to small businesses and focusing on women and people of color, we'd be like, this is a risk that we think is worth taking. Now, we have no idea where this could lead us, but if we as philanthropy, the thing that I say to our board all the time, if we don't do this, who's going to do this?
Right.
Like, who's going to take these risks? And so for us, that's why we describe it as uncompensated risk, because we're like, well, someone's got to do this, and if philanthropy's not going to do this, I'm not sure who is. And so that's why I think it's a role that we play, and I think it's an important role to play.
The but-for capital. Yes.
So I'm so glad you brought up blow-ups, because one of my favorite moments in impact investing conferences was a moment when I think Liesl Pritzker was sitting on the stage, and she was like, every time a single impact investment in my portfolio blows up, people are banging on my door saying, see, it doesn't work. Meanwhile, in 2008, I lost 40% of my capital, and everyone's like, that's just how markets work. There's this absurd expectation that every impact investment will be perfect, but traditional investing, you're going to have some value at risk, and that's fine. So much of this is just around reframing the conversation. And an advice unsolicited I would offer is, if you're thinking of entering into the space, have that conversation with your investment committee and stakeholders prior to doing the transactions. Because if you frame every darling investment as a perfect little, sample portfolio that will definitely win, I promise you some of those investments will go sideways. That's not impact investing. That's just how investing works. So that's one tirade. The way we think about risk and return.
This is still investing.
Exactly.
That is
this
a
is still investing.
critical comment.
So in terms of risk and return, I will say first and foremost, and I'm so grateful to our trustees for anchoring in this, as a foundation, the point of this money is not to make more money. The point of this money is to achieve the mission, which is something I think we often forget as investment professionals in this space. And so sometimes that means maximizing financial returns for grants, but usually it means something else. And so reframing, from a fiduciary perspective, we believe that. The point of this money is to pursue the mission. That being said, I think we've all had the trade-off conversation plenty of times. 2017, we had 15.9% returns. The returns here don't need to be concessionary. But I do think there's a role for foundations to take concessionary pieces of the capital stack when appropriate. And I think part of our collective job, I've recruited you into the space, our collective job in the space is to do that analysis thoughtfully and be very transparent about when we're taking that risk, what is the nature of that risk, why we're taking that risk, if there's somebody else who's better suited to take that risk. And the last thing I'll say on that, which is something that's top of mind for me these days, I feel like we as a space are getting more sophisticated in that risk-reward analysis. The thing that scares me is that we are still fairly glib when it comes to stakeholder risk. So the number of times I've been in rooms and in pitches with people who I, again, respect, and including us, because we all fall prey to this, who are innovating, because innovation's really exciting, and accepting we're going to take the financial risk, the investment might blow up, without fully appreciating if that investment blows up, it is on the backs often of the low-income people, often brown and black people in emerging markets who can least afford to take that risk. And I really, this is a plea to the space. Let's talk explicitly about stakeholder risk. Because even if we're willing to lose the financial capital and capable of losing the financial capital, what does that mean for the people who we've enlisted into the movement and we've convinced to join the startup, we've convinced to buy the assets, we've convinced to join the community wealth vehicle? How do we protect those people? Because they are the ones who are least eligible and least capable of taking that risk. And I really want to see us have that conversation.
Anything you want to add on the risk and return?
It's tough to follow these acts over here. I mean, I would echo everything that has been said, and maybe just digging in a little bit on the sort of trade-off and risk-reward conversation. We talked at the beginning, sort of explaining how a foundation works, and the old model was really straightforward, right? Your investments were in one side of the room, and their job was to maximize profits on a risk-adjusted basis. And if you maximize profits, you maximize the money you have for grants. And if you maximize grants, you maximize your impact. And that was the formula, and it was a very sort of cause and effect relationship. But we know that it makes no sense, and as you sort of highlighted with your identity crisis example, it makes no sense to go to a community that's been ravaged by the acts of a corporation and tell them, great news, guys, this year, instead of a grant for $100,000, we're going to be able to give you a grant for $102,000 because we invested in that company that made your water undrinkable, right? We know that that doesn't work. So regardless of whether a foundation thinks of itself as an impact investor or not, its investments are having impact, and it's only a question of how you manage that impact. But that sets up a much more complex and I think interesting formula to try to solve for. Because now it's not just about maximizing the profit on the endowment, right? It's about maximizing the institution's impact, which includes impact from your investments, which includes impact from your grant making, which includes the way that you use your human capital, the way that you leverage your voice. So I think we're just sort of beginning to develop the vocabulary to talk about those kind of trade-offs and how we sort of push a new operating model in that light.
Fantastic.
Can I just add one
please,
thing that I think the other thing to build on Preeti's point, though, is even on impact risk. I think one of the things that I find frustrating is that everyone assumes that because you make an investment, it's going to have impact. Not all investments, sometimes we just don't know. That's part of the risk that we take. We keep thinking risk-reward in a financial sense. The risk-reward framework still applies to the impact side as well, and it's a conversation I had with a grant colleague of mine that I said, well, what do you want our impact capital to? We want to be catalytic. We want to take risk. We want to change systems. We want to be innovative. I said, so that means we take impact risk. Like, no, we can't take impact risk. I go, all the words you just used are things that have never been done before, are inherently new. And so we are taking impact risk, whether you acknowledge it or not. Some of these investments may not have the intended impact, and they may have negative impact. If we don't acknowledge that and talk about that, then we're actually, to Preeti's point, doing a significant disservice to the communities we want to serve, but we're also deluding ourselves that we actually think we're doing good when we're being quite destructive. So I think that that's part of the conversation that needs to continue to happen, that we continue to push within Surdna as well.
Great. And I have one more question while you in the room think of your questions and come and prepare, because we're going to transition soon, so feel free to make the queue. I think this question of fiduciary is really important. And in the sort of investment consulting world, right, we have this document, the investment policy statement, which is sort of the decision hub of how we allocate our portfolios from an asset allocation, risk and return, and in best case scenario, align with impact as well. So maybe just, I'll start with you, Preeti, because I know Heron publishes their investment policy policy statement. So if anybody wants to go and read one, that's a great example of an integrated approach to thinking about financial and impact objectives. But just talk through your kind of decision process on defining the IPS, how often you guys revisit it.
Sure. So take a look at our IPS if you're interested. It's on our website. And you'll see our IPS, I think like many in the space, tries to distinguish between the legal investment policy statement, which is a fiduciary document, and the preamble, which is the world as we want to see it. And we fully appreciate that the world is not as we want to see it, but that is not an excuse to not vision for the future.
Yeah.
And so you'll see kind of 10 investment principles, which are aspirational, and a legal document that we're complying with. And you can drive a truck between the two. But our goal and our work is to bring them in closer and closer alignment. It's probably like a step function. Every few years, we do a fairly significant overhaul of the IPS, and then we tinker with it. And then we do a significant overhaul, and then we tinker with it. I think our latest overhaul was maybe about 2-3 years ago. We're probably due for another one. But it's something we at least revisit every year.
That's great. Yes, please, I saw a question here.
Hi, my name's Ginza. I'm an undergraduate at Columbia. I just had a question about, particularly when you were talking about how a failure might impact the community and the black and brown people and the low income populations. At what point do each of your foundations sort of call failure on an impact investment? Is it if you're not receiving a certain amount of return back, or is it more focused on not creating a social impact? So if you guys could speak about that.
I have a favorite failure. I don't know if you guys do.
Oh, she got her name.
And by favorite failure, I mean one that completely reoriented our practice. So we made a large investment that we were really proud of. And it was an investment in an anchor institution, so a large educational facility, I'll call it, that was designed to create a lot of jobs in a low-income community. So this is a community that had high rates of unemployment, and if we helped this anchor institution expand, it would hire more people. And so all of our impact metrics were around jobs created, and we tracked it, and it actually ended up creating way more jobs than we originally expected, and the money was flowing, and we were patting ourselves on the back saying, this is what impact investing is. And then we got a phone call from a nonprofit in that community that said, hey, did you make an investment in that institution? And we said, yeah, that was us. And they said, great, they keep hiring people. And we said, yeah, that's the point. And they said, well, every time they hire people, they build new parking lots for those people to park. And every time they build new parking lots, it exacerbates a stormwater runoff problem, which is literally creating sewage in the streets of the neighboring low-income community. And we're like, hold please. And we're not, EPA stormwater specialists.
Sure.
We know nothing about sewage and stormwater, but I mean, that's a massive failure. And we ended up having to go in and remediate and finance a bunch of remediation efforts to help resolve and ameliorate that problem that we absolutely accidentally exacerbated. So when we think of things that have been failures, even though there were ways in which that investment went well, there are other ways in which that is deeply embarrassing and has completely reoriented so much of our investment practice.
I mean, I can give an example from a previous incarnation, because our portfolio is relatively young, right? So we haven't seen any failures yet. And so when in my previous role, we invested in a hospital chain in India that was providing maternity care to low-income women. And that hospital chain had expanded faster than it should have. And so the debate that we were having is, do we shut down some hospitals? And the question was, if we shut down some hospitals in certain communities, women that are actually accessing maternity care will no longer have access. But we're also like, but if we don't shut down these hospitals, the entire company could go under, because those money-losing hospitals could completely bankrupt the entire business. And so that's the tough decision that you have to go through, and I don't think there's a clean calculus that we had to go through. Ultimately, we had to make the decision to shut down a couple of hospitals because we wanted the long-term viability of the business ultimately mattered. But it wasn't just a pure financial decision. It was sort of like, if this entire company doesn't exist, forget the 2 hospitals we have to shut down. The 8 that are open will no longer exist as well. So it's a constant debate. I just think that this is where I always go back to, what are our values? Why are we doing the thing that we're doing? And then that'll help guide us. And I think that people underestimate the role of values. Like when I joined Surdna, I was like, what are our values? And one of our board members was like, why you, the investing guy, care about values? I'm like, if we don't have our values to guide us, because in the investing role is where we're making the compromises, Those are the things we have to go back to, and those help us make those decisions.
That's actually a great point, Shuaib. Somebody gave me advice once that whenever you're interviewing at a new company and thinking about pivoting to a different role, read their mission statement, read their values, and really, understand A, how those resonate with your own, and B, ask the questions during your interviews how those resonate throughout the company's culture as a great way to start. I think there's another question.
Hello, my name's Ashley Pollockcourt. I'm from Bloomberg on our private equity platform. I wanted to ask, it's a two-part question. From the conversation about the fossil fuel investment plus other alternative energy investments that you were talking about before, especially your example with the Appalachian Communities, how do you have those conversations with the stakeholders that you're investing in their communities still because it's an important investment, but you're also investing in companies that will replace them? But also, if you're investing in companies that will support them directly as the other energy resources leave, as well as how do you have that conversation with investors?
And maybe building on that, any workforce training or any sort of aspects of reinvestment in other skills that may help that transition.
Sure. So very quickly, a literal answer to your question is you have those conversations with a lot of transparency and frankly humility, because we're not right in those conversations. We're just doing the best we can. And I think a lot of it is about servant leadership, which is a model that we take more and more seriously in this space. The idea of deep listening to our community partners, and which often means we get yelled at. We get yelled at in every room we go into, and appropriately so. We are carpet bagging in from New York as a capital markets player, and it is our job to shut up and listen. And so we take that responsibility really seriously. And it means these simultaneous, we try to find partners who are capable of thinking holistically, and oftentimes it's the community partners, like a mayor in a coal town can see the direction which their community is going, and they often have recommendations for workforce development, just transition, policies and practices. They often know who are the good corporate actors and bad corporate actors, even from a safety and compliance standpoint. So often our job is to shut up and listen.
But I think you just mentioned just transition, and that's something that we talk a lot about within Surdna as well. It is, how do you have those conversations? And again, it's with our partners, right? There's so many foundations that we work with that have roots in Kentucky, for example, Kentucky's for the Commonwealth, that are really advocating what does that just transition look like. But part of what I think our role is as well as a foundation is we sit in a lot of different rooms and to carry that message into a lot of different rooms as well, right? So it is the ability to go into some of our investment managers and have the difficult conversation, but also and again, this idea that even funds and companies that are doing positive climate change solutions are sometimes bad actors in their employee practices and so on and so forth. And so part of it is, again, it goes back to there's no silver bullet, but part of it is we have to call it like we see it, when we see it. We have to listen, but then sometimes we have to speak our truth as well.
And I think it's also seeing issues systemically, right? Understanding the unintended consequences, not looking at trying to solve a single issue, but really understanding the intricacies that creates. And inside of your portfolios, either it's the traditional side or the higher risk side of the portfolio, and getting folks on board with that. Yes.
Hi, my name is Ana Maria Gonzalez. I am an Obama Foundation scholar from Colombia, in Colombia. First of all, I want to thank you very much for this panel. I think it is very grounded, and I consider that to be a little bit. It has a very different tone from other things I've heard during the day, especially because I think you raised great points. For example, the stakeholder issue, the securities for the stakeholder issue. I think that's a crucial point, and in that direction, my question is in two levels. Like, for me, it seems that this is one of the answers. I definitely think that a way to create convergence is to bring in entrepreneurship mindsets with the money and the capital and make them all work together. But the reality of sustainable interventions in communities is that most of the good part of it is bottom up, and the communities are the ones that know better how to do what they need, to solve their own issues. And usually all this jargon and return of investment, producing a cash flow to explain the social value, is something that is really far away from the learning curve of the community leader. So how, in what level are you like solving that? Because I work with illiterate communities in Colombia, and what we do is we are helping them. We give university students to their managerial points to help them solve that issue, but I really think it's a structural issue. Like, doesn't capital investment in social issues reproduce inequality in the sense that it still keeps it in a very elite, educated group of people that really don't tap and come as solvers? And I really don't believe in solvers unless they create good pipelines to communicate with the ones that need those things solved for. Does it make sense? I mean, it was weird, but I...
Yeah, I think you bring up an excellent point. I'm just going to couch the responses because I know we only have a couple of minutes, and it's a huge and critically important question. To be fair to the panelists, this panel was structured as more of the top-down kind of, like portfolio construction. Let's talk about how we align our financial instruments with generating positive impact in the world. And this isn't a panelist of programmatic experts who are on the ground delivering, educational content to stakeholders. That said, right, they're interconnected entities and working together. And so I'm sure there's some stories that you all could bring apart that might be relevant to that question.
So I'll say for us at least, and this is both in my previous career and currently, I think that part of this is we recognize that that is true. We think that's a criticism of philanthropy. We think it's a criticism of impact investors because it's everything that you just described. So yes, that is true. And I think that part of when we think about even access to capital, when we think about, okay, well, how do we support entrepreneurs that are not traditional entrepreneurs that have all the traditional metrics, but we've invested in platforms or companies that are saying, okay, what are alternative ways to do credit assessment? Because these, for example, in my emerging market work, these are people that have never been part of the formal economy, but are extremely sophisticated, right? And I think that that's the thing that everyone forgets. Like, some of the smartest women I've met are in rural parts of Pakistan that are farming. They're extremely sophisticated, but they don't have the tools and the language. And so part of when we think about some of the investments that we make is how do we meet people where they are, and how do we think about what are the tools that we can leverage to enable people to get access to more capital. So it's all the way from, in the United States, an online lending platform that is reducing the cost of borrowing to small businesses, but looking at alternative ways to do credit assessment. In emerging markets, for example, back in the day, I invested in a company that is using cell phone data and cell phone credit data to do credit assessment and risk assessment of a borrower. And so it's really meeting the borrowers and individuals where they are and saying, okay, how do we work with them in their reality? That requires us to be extremely empathetic. That requires us all of those things. But it is a challenge. But it is something that I think has been on I think within philanthropy, we continue to discuss it. I don't think we're necessarily figured out the solution, because if you look at all of us, we're all not from the communities in terms of the ones that we want to serve. But I think it is something that we do think about. It's how we make our investment decisions. It's not always perfect, but it is there and it is relevant.
Bob, did you have something to add to that question?
Well, I mean, I just want to acknowledge that your question really does cut to the heart of a lot of conversations that we have in our boardroom. As a social justice funder who is fighting inequality and whose endowment in some ways represents inequality, right? There's a deep philosophical wrestling that has to happen with that. I do think that there are opportunities for us to do better. I do think that there are ways for us to get capital to entrepreneurs in communities that are not being served very well by traditional markets. One quick example that I would cite is we know that one of the most entrepreneurial constituents of our society is actually women of color. They've produced a tremendous amount of new businesses over the past decade. Women are producing about 1,800 businesses a day, so they made about 30 businesses while we were having this conversation. And 8 out of 10, nearly 80% of those businesses that have been created over the past decade have been created by a woman of color. And yet, the portion of venture capital that reaches those women of color is a fraction of a percent. So there's a tremendous opportunity there, both to look someplace where the market is not serving well, but also to activate our endowment as a tool for economic justice.
Thank you for your question. And we're going to round out today's conversation with just a quick fire round. I'm going to ask each of you to share for the audience one resource that you would recommend that they check out when they leave the room to go deeper in this conversation. I'll kick it off. If you haven't read the Mission Line 360 from Morgan Stanley, you can go to morganstanley.com/missionline360. And it's our look at building a roadmap for foundations like those on the stage to orient capital towards mission alignment, both human capital, philanthropic capital, and of course the investable capital. Bob, you want to start?
Well, there are some great networks that have served us very well. So Confluence Philanthropy, Global Impact Investors Network, Mission Investors Exchange. So I would start there. They make a lot of resources available to their members and on their websites.
Great. Preeti?
I'm going to cheat and give two. So Impact Alpha, if you're not already reading it, really great newsletter. And then within Impact Alpha.
Impact Alpha.
And then on Twitter, because a lot of the stuff that these organizations do isn't on the New York Times homepage, but it's on Twitter. So if you follow the Impact Investing hashtag on Twitter, that's where we get a lot of our what deal flow is happening.
Or
So-
add a Google alert for impact investing.
Yes.
I did that probably 10 years ago, and now I'm just inundated.
So I would actually say the GIN, because I think one reason that it's an important resource for me, because they do a lot of thought leadership, right? So the Global Impact Investing Network for me is just, they put out a lot of thoughtful research in terms of asking sometimes the tough questions and not always having answers to them. So that's where I would really go into, but Impact Alpha is a significant one as well.
Great. Huge round of applause for our panelists. Thank you.